The Intelligent Investor. Summary. Welcome back to the channel. Today, we're diving into a legendary book in the world of finance and investing, The Intelligent Investor by Benjamin Graham. First published in 1949, this classic has been called the Bible of Investing and has guided countless investors, including Warren Buffett, who calls it one of the best books ever written on the subject. Unlike books that promise quick riches or shortcuts, Graham focuses on timeless principles, discipline, and protecting yourself from mistakes. Let's break down the core lessons in a way you can apply in your own financial journey. Lesson 1. The difference between investor and speculator. Graham explains that most people confuse investing with speculation. Speculators chase trends, gamble on stock prices, and focus only on quick profits. Intelligent investors, on the other hand, think long-term. They buy businesses, not just stock symbols. They look for safety and steady growth, not gambling thrills. Takeaway: don't play the stock market like a casino. Invest with patience, logic, and long-term goals. Lesson 2. Mr. Market, your emotional partner. Graham introduces the idea of Mr. Market, an imaginary business partner who offers to buy or sell shares every day. Some days he's optimistic, offering high prices. Other days he's depressed, offering bargains. The intelligent investor doesn't get carried away by his moods. Instead, they take advantage of them. Takeaway: the market is there to serve you, not guide you. Be calm when others panic, and cautious when others are greedy. Lesson 3. Margin of safety. This is Graham's most powerful idea. Always buy investments with a margin of safety, meaning you pay less than what you believe the company is truly worth. This protects you from mistakes, downturns, or bad luck. Takeaway: just like engineers build bridges stronger than needed, investors should build a cushion in every decision. Lesson 4. Defensive versus enterprising. Investor. Graham divides investors into two types. 1. Defensive investor. Wants safety, minimum effort, and peace of mind. For them, a simple mix of bonds and index funds is best. 2. Enterprising investor. Willing to put in time and effort. They carefully analyze stocks, hunt for undervalued companies, and take a more active role. Takeaway: know your personality and risk tolerance. Both approaches can work, but discipline is non-negotiable. Lesson 5. Controlling emotions. The biggest enemy of investors is not the market, but their own emotions. Fear makes people sell too early. Greed makes them buy overpriced stocks. Graham emphasizes that intelligence in investing doesn't mean IQ. It means emotional discipline. Takeaway: successful investing is 90% mindset and 10% math. Lesson 6. Long-term thinking. Graham warns against chasing fads, hot tips, or short-term profits. The intelligent investor sees stocks as ownership in real businesses, which grow over years, not days. Takeaway: wealth is built slowly, steadily, and patiently, not overnight. Lesson 7. Protect yourself from risk. Never put all your money in one stock or sector. Graham suggests diversification, a balance between stocks and bonds, and avoiding debt. His message: don't risk what you can't afford to lose. Takeaway: protecting your money is just as important as growing it.
Conclusion. So, what does the intelligent investor teach us? That true investing isn't about excitement or gambling. It's about discipline, patience, and protecting yourself from mistakes. By focusing on a margin of safety, controlling your emotions, and thinking long-term, you can build lasting wealth. Benjamin Graham's wisdom reminds us, the intelligent investor is a realist who sells to optimists and buys from pessimists.
If you found value in this summary of Intelligent Investor, please like, share, and subscribe. Let's spread financial wisdom and help more people make smarter money choices.